So what could this be telling us? Well, it's telling us that the central banks are going to have to step in and inflate the system massively. I think there's trouble in the credit markets, in the financial markets, in the banks, not just in the U.S., but Western Europe, the U.K. And we know that the Fed's going to end quantitative tightening by the end of this month. Wednesday, November 12th, 2025, Maneco 64, home of alternative economics and contrarian views. So yeah, I'm back from Zurich, from the Precious Metals Summit. It was very interesting to be there for a couple of days. Yeah, Rudy was very happy when I got back from the airport last night. And we've been for a walk this morning already. And yeah, back to normal. And today, though, we're going to look at the Bloomberg Commodity Index and gold and the 10-year yield, because thanks to a friend of mine who's going to come on the channel for an interview, and I used to work with him many years ago in the city of London. We worked together at MF Global, or Men Financial, and he's a gold bug. He still works in the city, but he said he wants to come on. And thanks to him, I saw this morning that the Bloomberg Commodity Index seems to be breaking out of a very long-term base for the last 2-3 years. And I think it could be pointing to inflationary pressures. I'm not saying that the commodities are going to create the inflation, but they're going to show us that there is inflation in the system. Of course, inflation, the right definition is the creation of currency and credit out of thin air, or at a pace where the real economy can't keep up with it. So you end up with too much money and credit, and that leads to higher prices, not just of commodities, but a lot of other things. Of course, there are some items that might not change in price, and in the last few years, the basic commodities haven't, and gold and silver have led the way. But before we do, just wanted to tell you a little bit about the conference. I've already told you some of the what some of the speakers said, and also the sentiment at the conference. So yesterday, I listened to Rick Rule. He had the early morning keynote speech, very good speech. He didn't use any charts or anything, quite entertaining. And one thing he said about the gold market is that it's not a contrarian investment anymore, because we've gone from $250 at the beginning of the century now to above 4,000. And he's got a point there, even though I still think with the general public, it might still be a little bit contrarian, because very few people are still involved, not just the public, but also big investors. They don't have too much exposure to gold. But be as it may, yeah, not contrarian anymore. So is it time to get out? He doesn't think so, and he used maths to explain it. And basically, he went through all the numbers, fiscal numbers of the U.S., how much wealth the U.S. has. Like, I think 168 trillion is the net equity of all U.S. wealth. And then he went through the 31 trillion net public debt. It's not debt owned by U.S. agencies or the Federal Reserve, right? And then he went through the unfunded liabilities and also the deficits that the U.S. Government is running every year. And we are almost at a point where all these obligations and debt is matching the net wealth of the U.S. And he doesn't think that the U.S. will default. It won't do something like Argentina has been doing for the last century, because politically they just kick the can down the road. And the default that they're going to do, of course, is through inflating the system. And actually, what I'm going to talk about today about the Bloomberg Commodity Index, how it's pointing to inflationary pressures, I think matches that. So he thinks, it's not contrarian anymore, but the reason to have gold exposure is still there, and it's a fiscal reason and political reason as well. Politicians and even the general public, they'd rather have inflation than a major deflationary collapse like during the Great Depression. So yeah, that's what Rick Rule said. And I also spoke to the organizer of the conference, nice lady, and she said that the number of people attending this year was 650, and last year was 500. So yes, there's more interest. And she said the increase was all on the buy side. What does that mean? Well, it was all investors. The number of mining companies attending were the same as last year. So more demand for learning about the sector and probably buying into the sector from the buy side. And just before we go into the charts and the Bloomberg Commodity Index, gold, and and also the 10-year yield, just want to tell you a little story yesterday about when I was at the airport in Zurich. I was early. I like to be a little early before a flight. And I was walking around near the gate. There were some shops. And there's a big shop. It's got everything about Switzerland, a lot of items and stuff. And I was standing outside that shop because I had a look, didn't really want to get anything. And then this man walks up to me and he says, "Hi, Mario." And he's English, actually, sounds English. And he was wearing like a tag, like he worked somewhere. So he ran that shop and he follows the channel. And he said, "It's so great to meet you. I listened to your video this morning, i.e. yesterday, and I was in the hotel in Zurich, and I said, I'm going to be leaving this afternoon." And so he knew I was going to be in the airport, and he found me. And his name is Simon. He's been following the channel for a long time. He wanted to go to the conference, but he couldn't make it. He said he's going to try to make it next year. But one thing that I really appreciated is that Simon had a few gifts for me. He had Swiss silver coins, or the pre-68 coins. He had the 5 franc coin for me, the 2 franc silver coin, the 1 franc, and the 50 centimes, or Rappen, as the Germans say. And they're in beautiful condition, as you can see. And they're all from 1965, and he apologized that they weren't from 64. I said, well, don't worry. I'm very grateful for these coins, and it made my day when I meet people like that watch the channel. My wife and I went to Venice in October. I don't know if I told you this story, and we were having breakfast downstairs in the hotel, and there's a American couple sitting next to me, and the gentleman asked me, "Aren't you Monaco 64?" So he watched the channel too. So it's interesting sometimes to meet people like that. It doesn't happen very often, and yeah, it's really great to have met Simon, and I'd like to thank him for those coins as well. Anyway, back to the main topic. One chart I want to show you first is, where is it? It's the chart of gold and the Bloomberg Commodity Index, and I've compared them going back to July, I think 2016, and it starts at 100, and you can see that gold has outperformed. Gold is up 331% since July 2016. The Bloomberg Commodity Index is up, it's at 123, so it's up 23% only. And if you look at in 2020, the Bloomberg Commodity Index dipped very sharply, just started dipping sharply just before the correction and the crash that we saw, the COVID crash. And it bottomed in March, just like gold did. But gold started taking off and traded up. I remember at the time, I think it was over 2,000 by the summer, while the Bloomberg Commodity Index, it started trading higher, but it was nowhere near the previous high prior to 2019. It only took out that high sometime in the summer of the next year, in 2021. Excuse me. And then it kept going up while gold corrected, right? It went sideways. And then in March 2022, gold went down, and the Bloomberg Commodity Index also went down. And it's been on a sideways pattern since I would say the summer of 2023 or spring of 2023. While gold actually has started catching up and making new highs from early, I would say early last year, spring of last year, and it's continued to do so. But now, and we're going to look at just a chart of the Bloomberg Commodity Index on its own. Now, it looks like the Bloomberg Commodity Index is starting to break out. And before we look at the chart of the Bloomberg Commodity Index, just want to go through the components of it, because some people might think, well, it's going up because gold and silver are going up, but not necessarily, because 30.1% of the index is energy, right? WTI crude, Brent crude, natural gas, heavy fuel oil, RBOB gasoline, and diesel as well. And then you've got 23.1% is grains, like things like corn, soybeans, soybean meal, wheat, and so on. And then 15.3% is industrial metals like copper, aluminum or aluminum, zinc, nickel, and lead. Precious metals, gold and silver, make up 18.8% of that index. Then you've got the soft commodities, agricultural, X grains. That's only 7.35%. That's things like sugar, coffee, and cotton. And then you've got 5.24% for livestock, live cattle, and lean hogs. So it's a really a good broad measure of all major commodities. So I think this bears keeping an eye on, because I'm going to also look at this commodity index compared to the 10-year yield, U.S. Treasury 10-year yield, that is. So you can see here how the commodity index rallied quite strongly from that March low, and it topped in June of 2022, and then it's been really in the bear market since then. It made a bottom sometime in May 2023, and then it's been going sideways. It's made a new bottom, but it's been going sideways, and now it's starting to break above. We've actually broken above the July 2023 high, and also the April 2023 high, and that's very bullish. That will get the momentum speculators and investors into general commodities, I think. And if you look at the comparison of the 10-year yield to the Bloomberg Commodity Index, and yeah, because that's the one that I think is really interesting too. The comparison is a little bit off. I mean, from 2020, 2022, you can't really see the 10-year yield because it moves so much, but suffice it to say it went down a lot. We were near zero in terms of yield. But after that, yields rallied, right, which is bad. Bond prices dropped, while, yeah, the commodities went up. But ever since 2022, 2023, bond yields have been under control. That they haven't gone higher. And I think now, though, it's going to be different because we could see another wave of inflation. And talking about waves of inflation, yeah, that's usually how it happens, or rising prices. That is, they come in waves like they did in the 70s. There were like 3 major waves of rising prices, and I think we could be close to that. So I think it's the commodities that are going to catch up with gold and silver, not the other way around. I don't think gold and silver are going to crash and catch up on the downside. So what could this be telling us? Well, it's telling us that the central banks are going to have to step in and inflate the system massively. I think there's trouble in the credit markets, in the financial markets, in the banks, not just in the US, but Western Europe, the UK. And we know that the Fed's going to end quantitative tightening by the end of this month. And I even think the head of the New York Fed, the most powerful of the regional banks, said that they're probably going to have to do QE again because they need to help the bottom 50%. So I think it's only a matter of time. And I think Jay Powell as well, he's going to be leaving in May next year. So yeah, he might want to kind of make sure things go smoothly before he retires. And even he spoke about the wealth inequality in the last FOMC press conference. I heard him saying, the bottom 50 is struggling. And I think, yeah, they need to inject liquidity and money into the economy to keep people going. And what that's going to do, ironically, is make things even less affordable. But as I said, politicians, central bankers, they prefer inflation to a deflationary collapse. And so do people. People would rather have a job, even though in real terms their wages are going down. They'd rather have that than be unemployed and have no income. So I think that's what's going to happen, and that's why gold and silver are just correcting here. This is what Rick Rule said yesterday as well. He said if you go out in Zurich to the expensive shops that they have there, and you see something that you like that's 1,000 francs, you'd rather have it for 500. So he thinks these corrections in gold and silver are similar to that. It's something that you want and you have and you want to have to protect yourself from inflation in the next decade. And whenever you get these discounts, like we did from mid-October, from 4,400 to 4,000, well, that's cheaper. It's a good time to buy. Despite that, he said, someone asked me, are you concerned about the correction in gold? And he said, well, gold was at 2,000 18 months ago or 2 years ago, and now we're at 4. What's the correction, right? Yeah, take it as an opportunity to load up. not just on gold, of course, but on silver. He didn't mention silver, but I think, of course, silver is still a really good place to be. And I want to talk a little bit about silver this morning as we look at the markets. So, because silver right now is up almost 50 cents at 51.67. Yeah, it's up just under 1%. The low yesterday, I think, was around 50.26, and it rebounded well at the end of the day. Today, the low is 50.86. Had a look as well at the Fibonacci retracements, because I think they're important. From the top recently in October, I think it was above 54, to the low, which I think was around, just below 46, or in the 45s. The 50% retracement is $50.08. So we're above that, the 50% retracement. They're important, 50% retracements. But for Fibonacci analysis, really, the golden mean, or the 61.8 retracement, and also the inverse, which is 38.2. Those are important, but the 61.8 retracement from the low to the all-time high is 51.15, and we're comfortably above that. Am I saying the correction is over? No, but it's looking better. We're still not out of the woods. Short term, that is. Long term, just try to keep accumulating this. I know I didn't accumulate this. I was gifted this, and I'm very thankful for it. In terms of gold, I did the same analysis. The all-time high was 43.81, I think, in the spot price. So the 50% retracement is 4,134. And right now we're at 4,115. We have been around 4,145 today and yesterday as well. So you can see that area there is the 50% retracement. That's quite important. And so it looks like gold is lagging in this recovery, lagging silver, which is interesting because silver should outperform gold in a bull market. So maybe that's another signal. But the 61.8 is much further away. It's just below 4,200. It's at 41.9250. So just wanted to give you those levels there. And I'm going to stop right here and wish you all a very good day. Take care. Bye.